All right, morning guys. I saw your message earlier, Peter, so hopefully you are online. Hopefully that's all sorted out. We're going to do candlesticks. It's more sort of technical week this week. Now, I know that you're probably going to know a fair bit about candlesticks, so we'll whiz through the first bit of the explanation of why candlesticks are useful, what they tell you exactly. We're going to have a look at a few more practical examples. Try and put a little bit of context around candlesticks. What I don't necessarily think works as a good strategy is the idea of having a very statistical view of a candlestick, that 70% of shooting star candles will produce a winning trade. I find these kind of things will often push you into trades that deep down are not going to work. So I think context is very important. That I think is probably one of the biggest things. And then it's down to your understanding of candlesticks, which allows you to then find those trades within the context of what's going on. I think that's probably the most important bit of it. So we're going to have a look at a few different sort of types of candles, different ways that I would look to play them from the most sort of textbook basic way of doing it, and then also got a few examples how they might sort of help you get a trade on. Predominantly for me, candlesticks are more to give me a bias in my direction, gives me an idea of what I think the market's going to do, where I think it's going to go. I'm not necessarily going to trade off every individual candle. It's more that I prefer to find a level and then find a candle that sort of shows me that perhaps this time that level is going to hold, or this time that level is going to break. Right, so move on. The whole point of why you're going to use candlesticks is a line chart won't really tell you a great deal once, and this is my point on context. Yes, we can see it's a trending market. Yes, you're getting a higher high and you're getting higher lows. Standard trending market. Or you're getting a range bound market. Now, what a candlestick is going to do is be able to tell you how well a market's doing at anything. And this, I think, important questions you should always be asking yourself. What's the market doing? How good a job is it doing of it? And most importantly, is it about to change? So if you start thinking the market's doing a bad job of whatever it's up to, your next question is it about to change? You can be in before everyone else realises it was doing a bad job. And a lot of people are going to need to see it come off, bounce, break lower, and then start looking to get short down here. Once they've gone, oh yeah, it's not going up anymore, the market's doing a bad job of this, I probably want to sell it. Whereas if you can work that out a little bit earlier, you can be in perhaps here before this break, and then everyone who jumps in down here is putting you further and further on side and allowing you out of that trade. So that's where sort of individual candles, I feel, help you out a lot. You'll hear me use this phrase a fair few times in the future as well. Gives you an access to a trade. Everyone can spot a trade, everyone can spot a pattern. The point of a candlestick, or whatever technical analysis you use, is to give yourself that way of getting on that trade. There's no point in just going, I don't know, for example, this range trade, and you want to sell the top of the range. There might be something in this move out of the range. Perhaps this turns out to be a candle that looks like that. So you had a move up and then the candle closes back down here. You've now seen this. That's the one that gives you the access to sell it down the range and potentially out of the bottom of the range. Whereas all of these others, you're just purely selling the level and putting a stop somewhere and hoping that it doesn't hit your stop. Likely, if you did that here, you sold that, put your stop there, you got stopped out. Whereas the candlestick then says, actually, that did a pretty bad job of stopping you out. Yeah, all right, it might have stopped you out. But it now says to you, yeah, you can have a go at this now. You can have a go at selling it. So a lot of the time it's that access in a trade, so finding the idea, and then the candlestick says to you, yeah, go for it. It might be that you don't get anything here that tells you to go short, and it goes down. You can't be angry about that. That's just the way it goes. You can't be on every trade and every break and every bounce. You know, if you could do that, you'd be a billionaire. Right, they all started back in rice markets in 1700s. I'll leave you to read up on history if you really want it. But essentially, it's visually easier to take in reds and greens or whatever colours you want to use. It just makes it a little bit visually quicker, visually easier. There's sort of a bar chart that's got a little dash and then a little dash at the top, and you've got, particularly if you've got lots of them together, this ends up being quite it's just an extra level of thought of, yeah, that one's definitely gone up. Patterns, candlesticks, so that either the individual candlestick, what that's telling you, or the candlestick pattern should work on every time frame the same. Obviously, shorter time frames are not going to be watched as much, so there's less and less people that are going to push that on. So what you need to appreciate is the setup of the larger time frame as well, because if you've got a nice little short time frame pattern and you think, yeah, this looks really good, but actually that's within a much larger, say, hourly candlestick that is extremely bearish, your short-term pattern up is more likely to fail, and that again is where that context becomes very important. Volume is generally quite key. I'm not going to say that volume is always key, but it's generally quite key and can often prevent you looking at sort of misleading candles. Remember, we looked at those liquidation type candles the other day. Ones with no volume behind them often didn't work quite so well. It's basically showing that there wasn't actually a great deal of activity that created that large candle. It's more likely a out of cash hours push that then hit a few stops out. So it's a less important candle. All right, so that's sort of your history. I'll put on a fair few of them volume where I feel it is important, where it sort of does tell you something. The other thing I find with candles, and this going back to that sort of what's the market doing, they'll give you an expectation of the volume next day as well, rather than just sort of after the fact looking at the volume and going, oh yeah, that was important. The expectation of what volume is going to be like, which can then influence how you're going to trade the next day, becomes quite important as well. Right, and I'll explain that as we go on. I'm assuming you all know the setup of how candles work. Green ones go up, red candles go down, so your open and close are signified whether they're at the top or bottom of green, top or bottom of red. Wicks and tails are probably the most important part of any candlestick, the sort of the more insignificant part of it, but I do think probably the most important. That's what's telling you if we've had a change and the degree of that change. If you've got a tiny little, if this one goes all the way to the bottom and you've got a tiny little tail, basically showing you that actually that's a very, very strong candle to the downside. That uptick at the bottom of the candle could have been someone going, right, I don't want to hold this overnight. Uptick, get out. So I think the wicks or buying, selling tails, however you want to phrase it, become very, very important. Tails at the top would be selling tails, tails at the bottom, buying tails. That's where buyers have taken over. That's where sellers have taken over. Is everyone happy with that? Candlestick development, this is my point that I was making on understanding where you are on a slightly longer term chart or a slightly larger time frame. That what you can end up seeing is perhaps this is a 5-minute candle and you're thinking, yeah, this is looking reasonably bearish. We've opened at the high. Absolutely no uptick, so there's clearly sellers are strong here. Sellers have clearly taken the initiative. They're taking the market lower. Yes, they've had a little bit of a pullback. But the problem is, until this candle is actually closed, this isn't actually telling you the full picture. Buyers could take over right now, run it higher, and you end up, well, sorry, that was the wrong way round of the example, but the point being, buyers could just run this straight the way higher. What you end up with is this candle is created by what looks like a very bearish candle that then gets buying late on. So wait till the close of your candles if you want to be sure of what it's telling you. Otherwise, you end up stuck in a situation whereby you're short down here going, well, this is super bearish, this is definitely going down. That last little bit of buying then instigates a little bit more covering, and you end up with candles that go this way, and you're wondering why you're short at the low. It never told you to be short at the low. Now, again, what you can also get is a situation where you could end up with two candles like this. So again, if you appreciate the larger picture, this is what we end up with. We'll say this is a 15-minute candle. Let's say it's a 30-minute candle for ease of the example. That could be your 15-minute candle followed by this 15-minute candle. And so oh God, bad drawing there. You know what I mean, 15-minute, 15-minute. What you can end up with is a push lower, which gets everyone bearish here, and then the other 15-minute candle runs back up and closes higher. This then serves to trap everyone in at the bottom. Everyone who's a little bit more short term gets trapped at the low, and then you get that quicker push up as we start breaking back above the high of this candle, because you've got all the short term people trapped in at the low. Now, where this can help you out is getting you in. This candle may not have ended up like this. We could have ended up with this dropping and then forming a new low. I'll show you a nice example of that in a minute, that you can use a short-term candle, so using this basically the other way round. You use a shorter-term candle to get you in for then the creation of a larger, slightly more bearish candle. You're already then in, you're already in a position before everyone who's a little bit more longer term, i.e. people who have got larger positions, who are more likely to move the market, then come in, and they're helping you out. Nice little example here. So this is the burn from December. What we're looking at is this low was quite important, and when we come on to profile week, we will have a look back at this day as to why that low is important, why we were looking for that low to break. So the situation was, coming into this from a context point of view, you're looking for a reason to be short. You're looking for some kind of way to get into this trade, because ideally what you want to be is short by the time we get here, with the expectation that either you can add on the break, or you can at least be in comfortable on side as it goes, and then you can just let it go. You can feel comfortable in that trade, and then pick your target, pick where you're going to get out of it. So we're all aware of this level, we're all looking for somewhere to be short. And this is what I was saying about accessing the trade. How do you get into this trade? How do you find a way to get yourself a nice position? Now, you've got a couple of different things to do. You could be looking for these couple of lows here, and then try and get short below those lows. So that low's 27, I believe. The low here is 18. So you've then got 9 ticks to get in.
So you say what time frame those candles for?
Oh yeah, sorry. This is 15-minute, and this is a 5-minute. So what you've got is, we've got a double top on the 15. You get a double top on the 5. Now, if you're playing that double top, you need a way of getting into this. And on the 5-minute, what you also get is you get a little shooting star candle. Now, technically this isn't perfect because of the fact that it's not actually at the high of the move. The top of the candles touch the high of the move. So we'll talk about that in a bit. But from a context point of view, the fact that you want to be short, this is giving you a way to get in with a reasonably limited stop. You could as this candle closes, it closes at 37. The high of the day is currently 40. So you could sell 37s on the next candle with a 5-tick stop. That's giving you the opportunity to play that double top in a much more aggressive way. Otherwise, the technical way to play it is you're waiting for it to get all the way down here. So you're then giving yourself a 15-tick stop if you sell it through this low, looking for that double top to work out. So by using a shorter time frame candle, gives you an in. By the time the 15-minute candle closes, we're down to the low 30s. So you're down around here, oops, down around 30. So that's where you're now going to get more people coming in. More people are going to see this and go, yeah, double top now, 15-minute candles closed lower than that double top. It's closed lower than the previous candle. I fancy this is now the time to be short. Those people are going to be taking 10, 12 tick stops over the high. You've already been put on side. You then, if you are short at 37, can have a go at selling it through 27s to add to your position. Giving you a little bit of space here. You've got this whole area of 9 ticks down here. That your average price is now probably somewhere around 32s. And now you can sit there and be a little bit more comfortable. So that's where using the shorter term or shorter time frame, particularly this week's probably been really helpful for it. Can help you out in terms of getting in, but appreciating what that bigger picture's telling you. Yeah, if you really waited for the close, you'd be selling it down at 24s rather than using that little short-term candle. Gives you the access to the trade, gives you a way to sort of be in it a little bit earlier. All right. Yeah, I didn't have anything else that I wanted to say about that. All right, candle types. Why is it not coming up? Aha, there we go. Right, basically you've got 3 different types of candles effectively. You've either got high conviction candle, whereby you have virtually no tail, opens at the low, closes at the high, or the other way around. What your expectation after a candle like this should be is continuation of that direction at least. And we'll come on in a bit about, particularly when we look at 3 soldiers or 3 crows, the context then within this. And what it's all about is the size of that candle. That's a huge candle, so sort of big range extension. One, yes, you should definitely be looking to continue in that direction. However, this gives you a little clue on context in terms of the market has moved excessively. It's likely then to have a little stage of calming down. So you may get a more consolidation candle the next day. Obviously, if this is a small candle and you've just got middle of the range, solid green candle, yes, buyers have been in control all day. But ultimately, if your range is like this and you've got a green candle here, yes, they've been in control, but the overarching theme of the market is that we're not going anywhere. So yeah, you might be able to buy it up towards the top of the range the next day, but that's all it's telling you. And this is where volume is important. You need volume to be bigger at least than the previous, but I'd suggest something more a little bit outsized compared to normal. So you want range extension and volume extension basically for this type of thing to help you out. Doji candles, indecision, basically that no one's quite sure what to do next. Now where these become very important, if this again is mid-range, that's telling you very little about the market. It's a range-bound market. People are already reasonably unsure about what they want to do. This is just showing you it on a smaller time frame. So when do they come important? It's the context in terms of direction going into it. If you get one of these right at the high of a move, that's basically showing that people are just not sure whether to keep going with this move. Now, seeing as the bias is, say this for example at the top, if the bias is very, very strong in that direction and people all of a sudden have no idea about it anymore, that's when you get the switch quite quickly, because all of a sudden what's changed from very strong conviction in that direction, everyone wants to buy it, to no one's really sure anymore. They can't even manage at least a small green candle. They've just merely got a total indecision. And so that can often call the top and bottom of a short-term move. Length of the wicks is quite important as well. If this is very small, then it's showing more likely a reversal pattern. If it's a very large, so long-legged doji, that's where you then need almost the next day will tell you what's going to happen. If the next day ends up printing a candle up here, then it's showing you that we're more likely to move in that direction, likewise the other way. So it's about which wick gets filled if you've got a large range doji. Don't think we've had an example of one of those for a little while. No, not really. We've got a few nice examples in the last week though, which has been good, because I can give a more up-to-date example of things. But yeah, that's always the thing to take from a doji, that basically people don't know what to do. So you want then, the next day in terms of how you're going to trade, is actually take your time a little bit, wait and see what happens, what the market tells you it wants to do. Because if you pick a direction straight off on one of these candles, unless it's a very small one at the top of a range or bottom of a range, you are essentially just guessing who or which side is going to do the most the next day. So it becomes a bit of a 50-50 punt. All right, finally, rejection candles. Essentially, that's exactly it. They're showing that the move has been rejected. So again, this has got to be towards the extreme of a move. If it's just mid-range, yes, it's showing rejection, but it's showing a rejection in a range. That's the whole point of a range, that you're always going to get prices rejected throughout that range. Now, the direction of it is important, but not entirely. This rejection candle is still going to show a switch of direction to the current. And so we'll talk about that when we have a look at a hanging man or a gravestone doji. That it's something that people often look at the wrong way. I've spoke to people on members chat in the past about why is that a bearish candle, and we'll come on and talk about that in a bit. So essentially, you see a candle with a very small body and a very large wick, you should be expecting to move in the opposite direction to the prevailing trend, not to the candle, if you will. Right, hammers, shooting stars, most basic, most obvious reversal type pattern that you're going to get, and one that we just used in that previous example. We had a really nice example on, you could argue, the S&P on Friday, the DAX on Friday. Yeah, both of those. Euro stocks as well too. In fact, Euro stocks is probably the best one. But like I say, this is your rejection candle. You've had a strong conviction, conviction continues, conviction fails. The next day, you want to be selling this candle. Now, in terms of a stop, and this I think is the most important thing with any candle pattern, you want it above the top of this candle, not necessarily above the body of this one. Because of the fact that this could well have opened a little bit lower and then closes with the body down here. You sell it here and put your stop here, ultimately there's people who still bought this candle that are still going to be in on that. So you need your stops up a little bit higher. That's where sometimes these can become a little bit dangerous. The really technically right stop to have is actually above the wick of that candle. But you know, if you took on even the Euro stocks today, put your stop below the low of the wick from Friday, you'll be taking a pretty hefty stop, even just on Euro stocks. So whilst technically correct from a day trader's point of view and a day-to-day type trade, is perhaps more frugal, if you will, to put your stop above that conviction candle. So once you start getting into that wick, because as soon as you get into that wick, the people who've sold it up here are now starting to get it wrong. And ultimately, if you're selling it on this day after a big convictions day, you're trying to guess the turn. And as soon as anyone trying to guess the turn doesn't get it right, they're going to be quicker to get out than people who have bought the sort of strong candle that has actually told them that they're right, whereas people who've not been told they're right yet are more likely to give up a bit quicker. And that's what you should, in theory, get. Target wise, this is the problem with individual candles. They're not necessarily going to give you a distinct target. For me, I would be looking at this as a move. In terms of the way I look at a lot of trades is, I want to look at something that is more likely to happen rather than what technically should happen. So a textbook would probably say that this move up, you then get, God, terrible drawing. You then get your shooting star candle. Textbook would say you should be aiming back to the low of this move. For me, I'd be looking the most recent sort of swing points, because that's an area that you could well get to and you can be quite confident of reaching that. A lot can happen on the way down to this, which is going to say that this is not going to happen. And for that reason, that's why if I'm just off an individual candle, I'm then going to be looking at other things. So for example, that Bund one, and they're going to be looking at another reason to stay in that trade, because ultimately I did think that there was more to that. But if you're just going candle to candle, I'd be looking perhaps for the next little areas to be getting out. The opposite to the downside, you break lower, flush out, all the sellers fail, and the buyers come straight the way back in. Everyone happy with shooting stars, hammers, all nice and easy. Right, hanging man. Gone the wrong way. For some reason I don't have a body on that candle, which is slightly odd. Right, what we should have is a little body here. Hanging man, for obvious reasons. This could be a man not looking so happy. He's got hung. He does look surprisingly happy after what's happened to him. This is the one that confuses people, because it's a rejection candle that way, so the assumption is we go higher. The problem is, well, not the problem, but the point is that's not technically the case, because what it's showing you is after you've had this strong conviction move up, sellers have had a go lower, so that's perhaps some of these buyers getting out. Sellers have had a push lower, and then this has got bought back up. Now, if the buy-in's that strong, this should just be an opportunity for buyers to come in, keep buying it, and take this move higher. What's actually happened is those buyers have failed in that. They've not even managed to get a new high on the move, or they might have, just about managed it with the body of that candle. So it's showing that actually the conviction in this buy is not really there, because surely if that conviction was strong, the buyers would have come in and lapped up the chance to get long down here for that continuation move, and then as it comes back up, take the opportunity to buy it through those highs to keep pushing that move on. They don't take that opportunity, and then you get the selling the other way, as all these buyers in here get caught out, and we then start to come off much quicker. Exactly the same the opposite way. inverted hammer, gravestone doji, you might hear it called, particularly if it's got a tiny little bit there. Exactly the same type principle that the the sellers here have failed in getting the move lower. They get turned over. Next day, in terms of how you're looking to trade this though, is you want to stop below that low. What you really want is to see it move into this wick, and that's where you want to be trying to find a way of getting into the trade. That's where you need to go down to a shorter time frame, find that entry point. Obviously, there's not really many of these where the open and close is the same price, so whichever's higher of the open or close, that again is the point for me, that once you start tipping over that, that's where you can then start thinking, yes, I want to have a go at this. So your stop becomes effectively the body of that candle, or the wick if there is a little bit lower. I do believe I've got quite a nice little example. Got a question? All right. Can we look at the 50% of a big green candle for a target, especially if it's on a daily time frame? Yes, yes we can, and we'll talk about that in a bit. So yeah, bang on, and we'll talk about why you would want to be doing that. All right, I've got a few different reversal candles here, a couple of different markets. We've got Bund and this is cable. So a couple of reversal type patterns. First up, shooting star in the Bund. This is in fact on a 15-minute chart, and you get a few of them. Sorry, you've got a shooting star and a hammer. All of them worked out reasonably well. If you had your stop beyond the candle that started the move in each instance, you wouldn't get stopped out on this because the next candle opens above it. So you're either not going to take this trade on, or you sell it on the break of the low of that candle. So whichever way round you decide to take it. The fact that it opens slightly above, remember this is on a 15-minute chart, so that is one tick up, and that could literally be the turn of the hour. It's bid 62.02, offered 03, the turn of the candle comes and someone buys a one lot into 03. It looks like it's been bid up early, and actually it's perhaps a little bit of a false signal. And each time, at the time of the day, that did call the high and low of each little move. And in terms of target wise, like I say, halfway back up this move, as Peace has just mentioned, becomes quite a nice target on that candle, becomes a nice target on this one, and even on that first one, halfway back, you could even then start having a look down towards the lows. Be sort of 25 tick winner. So nice little example, shorter time frame for the Bund. And then you've got a much longer term time frame, hanging man in the pound. Worked out an absolute treat after 3 days, very strong run higher. So a high conviction move up, gets sold off, the buyers come back in. Yes, they did close it just above the high. The next day can't even reach this area. So again, if you sold it just below the previous day's open, or as it comes through the previous day's open, then you're still quite safe. Yes, this is the pound, so yes, you are taking a reasonable stop on that. I believe your stop would have to be about 25 ticks to play it on a daily point of view. And this is where it comes tricky, and this is where I was saying about using it more as a guide or a way of giving you a bias on a trade, as opposed to necessarily always being a trade that you're going to take. Not everyone's going to see this and go, yeah, I'm selling that 30 tick stop, it's going down based on one candle. Swing trade point of view, it's a decent trade, but like you were saying, Victor, earlier on, no, sorry, Tom was saying, that you end up with quite low percentage win rate on a trade like that? It wasn't you, was it? It was Victor. So you end, when it pays off, you're going to make risk reward ratio. It works out very well, but win percentage, it can end up being quite a low percentage. This was, I think, at the time that this got hit, the high of the year. So that plays into it a little bit better. That it needs to be genuinely a new high, not say a high within a recent range, or the high of the last. For example, say this candle here, if that was a hanging man, ultimately you're in the middle of the range. That's the kind of candle that I would suggest would skew the statistics and end up catching you out that actually that's not going to be a good quality hanging man candle if it appears right in the middle there. All right. Morning and evening stars. These are, we'll talk about tweezer candles first. This is something that I'm not that big a fan of, because effectively all a tweezer candle is two shorter term candles producing the same candle. All that's likely to happen is you are perhaps going to get stopped out on the first one. So say that's two 5-minute candles. Ultimately, you've got a 10-minute candle that looks exactly the same. And so then you are perhaps more likely to get the buy. What it means is that there's a reasonable chance that you're going to get stopped out here, unless you do play it technically correctly, sort of textbook correct, and put your stop below the low. Then you do get away with it, and that's where that sort of more correct stop helps you out. Very similar to that example I used in the Bund a little while ago, that it was the 5-minute one gave you the in, you did need that stop just above the high to keep you safe on that. So they're actually tweezers. I do feel that they effectively look that it's just a shorter time frame version of a long time frame candle. So if it doesn't work to start with, don't be put off, because whilst you may not want to take it on the second time because you've already lost on it, this is where what it's showing you needs to override that emotion, because the fact that actually this is now a much stronger situation, it's now going to appeal to a slightly longer term trader who is then more likely to start getting involved there. And also anyone who has been selling it, sold it down here, got rejected, perhaps didn't get out, they sold it again, which perhaps brought in a few more sellers, and they then got rejected again. And so on this second move up, there's more people more likely to get out as well. So that's why sort of tweezer candle actually isn't too bad a situation. Right. For some reason I've got more than evening star here, so I was going to talk about them, and then we've got this situation. Basically, yeah, just as I was discussing about using bigger candles to prove smaller candles. Exactly the picture you get here, that you may get a short-term high conviction followed by another short-term low conviction, which produces that type of candle. Now, if you're using that shorter-term entry point, you may well have a 5-minute candle that looks like that just there, and that gets you in here before we end up with everyone else then piles in through the low. Same principle with the tweeted candles as well. Why is the ordering gone on this? Right, here's your evening star or your morning star candle, and that is small range doji at the high or low of a move. Now, it's always subjective when you say a smaller range. What I would be looking for is a less than average range, particularly after an extended range move. So I don't know, say you're in Euro stocks and this is a 100 tick move. Average move Euro stocks, maybe about 30 ticks on sort of a long-term average. So you then end up with, after a 100 tick move higher, you end up with a 20-ish tick range doji candle at the high of the move. That's where I'd be looking at that as, yeah, your sort of reversal type trade. And again, just like a shooting star, you want to be selling the next day with your stop above the high. Little bit nicer with these type of trades because the fact this is less likely to have a much larger tail on it, so it lets you in a little bit easier, or with a little bit of a tighter stop. Alright, let's see where the animation works on this one. We'll get them all up to start with. Right, haramis and inside days. I look at them basically as the same thing. There is a technical distinction. A harami candle is one whereby you get the opposite candle to the mother candle, and theoretically this is an indication that we should go lower. For me, the point of an inside day is this is a consolidation on the current move. So a break of either side of the inside day is either going to show continuation of this move, or we're going to go back the other way as everyone who's in long here sits through the consolidation, perhaps builds a little bit more position as well, particularly if this is a high volume candle, so a high volume inside day. The break then should be quite strong because people have started building more and more positioning within this candle, and then you either get the break to the downside or to the up. What I think is a dangerous game with an inside day is trying to predict it early. If there's a pattern that sets up, i.e., I don't know, you end up with sort of a short-term range within this candle, and then that starts to break to the upside, then you should be playing that range break anyway. That could then set you up to be long for the break. But what I think is a dangerous game is getting too caught up having a decision made once we're opening within this candle's range. If you've made a decision, you then get biased into playing that decision and aren't open to the fact we could go the other way and catch a load of people out. So that's how I was looking at an inside day. The key for me on an inside day is which way it breaks, and that should provide a bit of direction. The other side of that is if you get within the day a break that then comes back in. I don't always think that an inside day break, say this one breaks to the upside and then drops back in, don't necessarily think that within the day we need to break to the downside. However, you close back inside this and that then flips your bias that you should then be going for the other side of the range. Okay, we've seen a few nice examples of this recently. So, got sort of bigger one here, and then we'll go and have a look at a few that we've seen recently. This is something that I think the DAX quite likes. I think for me it's probably my favourite reversal type candle on the DAX rather than a shooting star or anything else like that. The evening star I think works very nicely. So there you go, not quite textbook evening star. That one is. That's absolutely, couldn't draw that better if you were given the opportunity to just draw it. Top of a move after a strong candle, shows complete indecision. The next day comes off and then is continued lower. And this is often something to watch out with those type of trades. It gives you the bias. It won't necessarily play that out for you straight away. Not everyone is going to the next day see this candle and go, right, this is going down. But once you've got this close lower, now people are thinking, yeah, this is going down. It's almost that this candle gives you the clue, this candle confirms that you're right. So again, that's where getting in that little bit earlier or having a bit of an appreciation of what's going on in the market, because not everyone's trading off candlesticks. gives you that little opportunity to be in first, and then by the time everyone else realises it, you're already in. You then get a gap down to put you one side further, and then the continuation lower. We also get a harami candle here, which is unfortunate the way it plays out because you don't get the opportunity to play the break. However, with the gap down, you get a shift back up, test the gap, test the close, and then goes lower. Not dissimilar to today in terms of the DAX coming back, testing the gap, testing the close, although Friday was distinctly not an inside day. But I do often expect that when you've got a gap, that you will get a test of the gap and the close the next day. So, nice little example in the DAX for a little while ago. You can see we're trading at 12,000, although the way it's fallen recently, you wouldn't be far off that again. Few more examples. I've got example here in the DAX again, the Bund, and in cable, either for a morning star or an evening star. And this DAX one, this was the record high about 2 weeks ago. Gap up, evening star at the high. Next day come in, we get the sell off, you then get consolidation. But the point with this consolidation is it cannot get back higher. Holds below, and then it goes. And this is where, and I remember saying to Samir about this as we started to break down, we just forgot about the context up there. That I'm not saying that you should be selling this and being short, because that's not, certainly not my style. If you're someone who's a day trader, who's perhaps in a trade for 15 minutes, half an hour, why are you suddenly going to skew your risk reward by taking on a 60, 70 tick stop in the DAX and then trying to run it for, well, as it turned out, 1,500 ticks? So it's a nice winner, it's a fantastic winner, but the point of the matter is you're going to suddenly change your whole strategy. But what it should be doing is giving you that bias that we want to be looking for some downside action until we get a reason not to. And what you then get as well is double inside day and a gap down break. And again, on that gap down break, you come back up, test the low, test the close, and then we come off once again. Now, don't get me wrong, I never expected this type of move off it. But once it started going, particularly once we broke through this low here, you could at least be expecting this close down here. You then still had closes much, much lower down here at 12,272. So it could, as the trade develops, you can then start thinking, yeah, this is really going to go now. So yeah, nice example in the DAX. Bund works very nice, and this is one which, again, you could end up taking this on a daily point of view. If you bought the open, you needed a 16 tick stop to stay in that trade. And as it happened, you bought the open, it put you straight on side. So you perhaps wouldn't have got yourself in too much trouble then. You might have been a little bit more comfortable to let it go. And it reverses the whole move. So that ultimately is your sort of big target on that move. You get another little added confirmation there as you break this high. That keeps you in. But, whoops, it is another morning star that ends the move. Pound as well, drop, you get this small doji candle. As with all of these, you expect that volume to be lower. This is consolidation. It's just down there at the sort of end of a move. So you're always going to expect that volume to be lower on these days. Difficulty is, I just said you'd expect it to be lower. You can't predict this type of candle, so it's only once you've seen it be as a low volume day that you can then sort of add that to the fact that you've got that evening or morning star candle. Right. engulfing and outside days. What this is showing you, I'll get all the bits and pieces up. Oops, one too far. What this is showing you is a complete change of sentiment. That positioning has gone one way, it has then got shown totally the opposite. Excuse me. Obviously that flip of positioning is effectively showing you that, one, you've got a load of people wrong, two, the market has got a lot of strength in it to be able to turn position in one way completely the other way in one go. Usually you would see it start to turn with, you know, a slowing down, a setup to go the other way, you know, perhaps your sort of reversal type candle. This effectively is doing the reversal and the move all in one, which is a rather strong sign. I have heard someone a little while ago, a guy who's very good on actual stats of these things, saying that actually bullish engulfing candles don't have that high a percentage chance of playing out. So take from that what you will. I do feel that if you then start the continuation, and this is where you got to add to the information you're given, that if you then get information that says we're still buying this, then you can go with it. It's the blind statistical buying that I think is where you get yourself in trouble, where you go, right, that's bullish engulfing candle, I'm buying it. Where's your stop on it? Quite difficult. You've probably either got to have your stop below there, or if you really believe in this candle, it's still bullish until it gets to the bottom of it, until that buying has been turned over. So that's the problem for me with the just purely textbook statistical let's buy it type situation. It's more a case, again, take it within context and then take what starts to happen on that next candle. If it does start to go, then yeah, you can start then to go with it. So difference or distinction between an engulfing candle and outside day. Your engulfing candle engulfs the whole body of this previous one. So you don't necessarily have to have the whole range engulfed, but the body's got to be engulfed. So implicitly, you need a gap to actually get this lower open. And then, so not only have you now got a gap in that direction, which should be bearish, sorry, I was just listening to Bank of England. That Vliga coming out basically saying that he believes there should be 3 hikes in the next 3 years rather than 2, which is what they talked about, which is one of the opportunities that we were actually talking about last Thursday. And you got cables just run up 10, 15 ticks, so not a huge amount. I think because of what Carney said, that they expect faster raising of rates than the market expects, that's perhaps why you're not getting so much of a move, because we all kind of know that. You can at least assume that if he says they're going to be faster, that they're going to shift from 2 at least to 3. So yeah, back to the engulfing candles. I would suggest that an engulfing candle is stronger because the fact that, one, you've got a gap that has then been reversed totally and then managed to close out everyone. So anyone theoretically who's short in this candle has definitely been proved that they're wrong, because we even got beyond the open of that candle. So anyone really who got short here is now offside, and that's why we should then get continuation. And that's where this doesn't necessarily always work, because the fact that unless you get that continuation, shorts can still have a go back the other way. sort of a bit of a to and fro type situation. Now, an outside day or an outside candle is one that opens within range, tests lower, and then moves higher. And effectively, it's just finding out that we have no more sellers down here. So, as there's no more sellers, you then get this extra buying comes in and manages to close. Generally, you would look for the close to be at least outside of the body of that previous candle, but what you don't necessarily need is the open to be outside of it. So this is more showing that you've actually had a test rather than a straight off the bat change of sentiment. You could end up with this as a little test lower as well. But this is perhaps slightly less bullish in the sense that this candle, because that gap has totally gone against the prevailing trend. This one has tested the prevailing trend, found out that there is no more to it, and then we're going to get the turnaround on it. All make sense? Sweet. All right. So I've got a couple of examples here in the euro, in this example, and in the DAX. Just move these down so you can see it a little bit nicer. What we've got is a couple of engulfing candles in the euro. We've got an outside candle here, which starts off the next leg of a move. We've had a very strong engulfing candle here in the euro. And then at the top of the move, after this spike up, so we had a reasonably strong move. Yes, we had a slight rejection here. We open and we get a bearish engulfing candle down, which then kicks off 2 more days, 2 more solid down days in the euro. So again, it's about using the sort of bias that you've currently got, or about sticking with the bias that you've currently got. The engulfing candles within range, I feel, are a little bit less important. So for example, this candle here is very much inside the range. Yes, we do get a gap up, but I wouldn't necessarily be expecting that gap up, despite the fact that you have got this outside candle here. It's an outside candle, it is a bullish engulfing candle as well. Is that reason to break a range? No, not quite so sure on that. I'd be more thinking about that in terms of you need to be towards an extreme of a range. So again, there's the strong candle. It has shown a little bit of a directional shift. You then get 3 smaller range candles coming back and another bullish engulfing candle. So that's the kind of one that we've already shown a turn. This is then confirming the turn. So I'm slightly going against what I was saying about it being in the middle of the range, but this is distinctly an outsized candle. It has taken out the range of this one and this one, and even above that close, that open as well. So that's a bit more of an important candle than perhaps this one, that's, whilst technically it is not actually context-wise really telling you a great deal about the bigger picture. This is DAX, and I've got a couple more examples of this. That this doesn't always have to be used on a daily. This doesn't always have to be used, you know, long term just to give you a directional bias. You can actually use it for a trade. And this is DAX on a 15-minute, I believe. So going straight off the open, and what you get is you've had an open that's shifted down. You then get a continuation which turns straight around, moves higher, takes out the top of this little range from the previous day, and that's where you then can start thinking, right, I can have a go at this. You can have a pretty tight stop on this, because what you're expecting is a move straight into the wick of this first candle and a continuation move, and it is what you get. And the thing with continuation trend days is they can often get quite slow in the middle. So actually, I do apologise, this isn't a 15-minute. I remember now this is an hourly, and also seeing that that's the close. This is an hourly chart. What you will often get is you'll get a surge early on, followed by then quite a slow period. So if you're not taking note or advantage of this candle, you end up seeing the break higher above this previous high, and then this. And that's where it's very, very difficult to get into a trade. It's very, very difficult to hold on to a trade, because each of these candles barely breaks the previous candle's high, or not by a great deal, and then in most instances is trading back into that previous candle as well. So any position you get is likely to cause you quite a bit of sort of pain within the trade, of going onside, offside, onside, offside, onside, offside, and it takes 4 hours to really sort of get you onside, and then finally you do get that secondary push up. Whereas if you've taken note of this first candle here, that's giving you the opportunity to get in early, take that first move, and then either take your profit because you've seen that sort of increased size of move, you've seen that increased sort of pace in the move, take your profit as we break higher. Alternatively, you can sit through this, because ultimately not one of these candles breaks the previous candle's low. So if you did want to trailer stop in that fashion, that will keep you in. And then you get the continuation. And that's quite a common feature, that if you have a trending market, which is what would be perceived as, you know, the thing that everyone wants a trending market. A lot of the trends are actually quite slow burners. It's a panicky market with people getting in and out of position that is often a much better market to trade, as opposed to a trending market which has a more sort of stable, sort of not manufactured, but a grind higher that has a much greater sort of structure to it and slowness to it and sort of purpose, if you will. So you want the panic. That's what really gets people going. That's why this candle here does have that extra pace in it, because that's where people panic. That's where people may well have sold it. That's where people who have seen this move higher go, right, I need to be in now. I definitely want to be long. And people will panic, rush in there. And then everyone calms down, realizes this is a trend day, tries to accumulate a position without just buying and driving the market higher. They get their position, and then you get a push on. And this is more sort of the US session by then. So that would have been up till 8, 9, 10, 11, 12, 1, 2, 3 o'clock. So yeah, just after the US Open, that's when we go again. Likely because the European move has forced a gap in the S&P. The S&P's gone with a gap and gone gap up and go. Right, couple of examples of engulfing first hours or outside first hours. Got them in the Bund, and this is today in the Euro stocks. So we will see how well this actually works out soon. Just having a quick look. Not too bad at the minute. We're still sort of sitting up within this candle. So I think until we get below the open, just there, then I think you can still be looking for longs in this. You know, it doesn't necessarily mean that you buy it straight off the bat on that candle. Yeah, the trade initially would be that, and you would be getting stopped out. We dip back into this candle, it starts making you look like it's not going to work out, but you would be looking at least for that beginning of a move higher there. So we'll see how this plays out for the rest of the day. I think Euro stocks, if it does hold on to this, we've also come back and touched the close as well. Holds on to this, I think you should get towards 33.98 to double O's area. So where are we currently trading stocks? 77. Yeah, I still think we've probably got 20 ticks to the upside. What we need to see is it sort of set up a little bit of a pattern. Just looking at the DAX, and it's had a bit of a an attempt lower that seems to have failed below 16s. So we could have
Came off the close of Friday as well.
what in the DAX?
Yeah.
Yeah. So you've seen this in the DAX, the Euro stocks, the FTSE, all gone down, hit Friday's close, and then rallied. So that's quite a nice sort of sign that we could be moving higher. The fact that we've gone down, tested it, found more buyers, and up we go on it. So that's good news if you're looking for longs, if you're expecting this move higher. And that's where you need to keep that sort of bias in your mind, that this could well be one that does continue higher, that does get that move going. Just looking at this, I'm just wondering about, well, you might have a little downtrend coming in the Euro stocks at the moment, and that break, if this little test up holds the downtrend, that break then could be what gets us going, gets us through the 98. And look, we've still got a close right the way up here, which is around about 34.70, I think. So you've still got quite a long way to go in Euro stocks if we are going to get a bounce. You want my opinion? I do feel that we have perhaps found a little bit of a short-term low in equities now, particularly with that S&P double bottom. The way everything rejected the breaks lower on Friday looks reasonably bullish, at least short-term. How far back we go, I think, is going to be the telling point. If we can't start breaking back for a few key levels, then that's where we might get this second leg lower. So yeah, use it for those first hours as well. It's can often really help you out there. Take it onto a shorter term. For example, if you look at this candle here, we've got the dip lower. You may well have been able to get in on this where you got this break of these lows. See, it's an obvious place for a breakdown. If perhaps you get this spike was made with a 5-minute candle that showed a rejection, that could get you in before you then start this move higher, which then once you've got the first hour in with rejection, you can then start pushing on higher. And again, more people wait for that first hour to finish. They then go, right, that's been a rejection lower. Yes, it's not an engulfing candle because there's nothing to engulf. But we've had the test lower, it's failed. Now people come in and try and buy it on that cash open. And that's a good thing with Europe as well, that the initial moves can then get flipped by the cash. And if the cash move goes the other way, that is a reasonably strong sign. So that's where Europe is quite helpful, having that first hour pre-cash. Right, quick sip of water. Any other questions on those type of candles or those type of setups? Nice and easy. Right, swing rebound trade and piercing candles. I think you hear various different people's interpretations of this, but this is the way I've always been, the way I've always had it explained to me, and the way I always look at it, that a swing rebound candle is one whereby you create a new high or low, and then you close back within the body of the previous candle, daily, hourly, whatever it is. So what it serves to do is stop the need for what exact shape this candle is. It's more to do with where it actually closes and what that tells you about the movement of that candle. And so effectively what it's showing you is that we push on, we break a recent swing, close back in. And so rather than perhaps a rejection candle that's not yet managed to close back in, within this candle we have shown that definitely there is some weakness in this market. The difficulty with these is because of the fact that we've already closed back inside here, you're then always going to have quite a large stop on it. So whilst I think that it's quite a strong indication, it's quite a difficult indicator to play because of the size of the stop that it will often require. The other thing with swing rebounds, it doesn't, some people will say it has to be the next candle. For me personally, I feel that if you've got, say, a market that goes like that, and then you get the candle here, not a great example, but right, let's draw it better. There we go. So you end up with that situation whereby the wick of this candle breaks that previous high. I would look at that as a swing rebound trade, despite the fact that this previous high could have been a week ago, could have been 2 weeks ago. What it's showing is that, yeah, we've made the effort to get back up there, we break it, and then everyone gives up. Now this could be a green candle here. Doesn't mean that we need to close down here, we could close here, but it's still showing you that the attempt higher has failed. So effectively a failed breakout of a range. And so it catches people long up here, turns them all over, and then that sets you up for a short. If we do get the close up here, it offers you a reasonably nice entry in that you can, well, sorry, a reasonably nice stop in that it would just be above here. Again, technically, you should perhaps have your stop right the way up, but again, that's where it becomes difficult from a day trader's point of view. That if you're not taking lots of trades like this with larger stops and also looking for a much, much bigger target, you do get yourself in a little bit of trouble if you suddenly decide, no, this is the one, I'm going to take it. And it doesn't work. In terms of targets on these, you should be looking for the most recent swing. So if that was the situation, most recent swing, that's where you'd be looking for, hence swing rebound type trade, or swing rebound name of the trade. So that's what you're really aiming for on a trade like this. Same thing with a piercing candle, but this is with a gap up. So it's a bit like a bearish engulfing, but we don't actually get the engulfing part of it. But you get a gap up and then a close straight the way back in the range, effectively showing that everyone who's gone for this gap up is wrong. They all then will then start doubting the trade once they get the close down there. Now that context again is quite important. If this has been a much, much larger move up, you get this gap up and then fail back in, there are going to be a lot of people who are not going to get out straight away on that because of the fact that they've seen it move a long, long way up to it. So it could then be the case that you get a move lower that consolidates, and actually it's this point here that you get the actual acceleration of the move. So for a lot of these type reversal trades, it will be quite a difficult one to start with, and one that you have to sit in and you'll think, come on, it's got to do something, it's got to go now, it's got to go. And so often, and this is something when we sort of talk about psychology on trades, so often it won't go, shows a little bit of pace and you go, yes, finally it's moved, take your profit, and then it goes, then it really accelerates. And this is something that I know I'm bad at, and something that I want to try and improve in my trading, that I will get the idea, sit it down to here, it stops doing anything, I start going, not so sure about this anymore, get out. If this goes like that, get out, and then it goes and does the proper move. It's so easy to get tempted into that. So you do have to sort of believe in the structure, believe in what the candles have told you, and then let that play out, let that go. But yeah, good things to watch out for, these sort of swing and piercing type candles. I think it is something that more you want to be looking for on a daily. Not too sure you really want to be looking at it on sort of 15-minute or an hourly type trade. But not on the rest. The point is, it is a rejection. You're certainly not going to get the piercing one on an intraday candle, because you're unlikely to get a gap on an intraday candle. Certainly the gap will only be 1-2 ticks, so it won't be significant. Your swing rebound, yes, perhaps you could play a little bit more. But from a daily point of view, I think the daily ones, it does work out rather nicely. All right, so here you go. I've got nice swing rebound in this again, was cable, and one whereby, well, you've got two here. You've got the first one that breaks within the range and then drops straight back into the current range. You then get a secondary one that breaks the most recent swing high, drops back in, and then goes. So that ends up creating the sort of proper move, where it's actually after the actual swing's been put in, you then get the rejection of it, close back inside range, and then we start to go. Now, the nice thing about this one, you've been given your context, so you know there's a bit of bearish context in this. You then, the following day, get an inside day, which is rather nice because that then gives you the opportunity to sell. So if you didn't want to be taking this on as a sell with your stop up here, so selling 43.20s with your stop up around 43.80s, you do have the inside day break to have a go at selling. Inside day breaks, that's where you can get on the move. There's your most recent swing low as your first target. And as with these, as I just talked about, you get the slow move to start with, and then you get a point where everyone long here then goes, right, I really don't want to be in anymore. And that's where you get that flush lower. So a much, much stronger move to the downside when people finally give up on it. The people selling it here are more likely people who are actually seeing this pattern and thinking there could be something in this, try and get short. People who are long would often use some perhaps technical point in the market. They ultimately don't want to get out, and they don't want to get spooked out by one bearish candle. Whereas people who are trying to play it the other way, trying to establish new positions, will start getting in here. You then get the acceleration as those longs give it up, and that very fast drop down. Again, same kind of thing here, and this is one where you get a nice green candle that's a swing rebound. Yes, the difficulty here is not really the top of the range. It's not really above the previous swing. So you've got a candle that closes back inside. It doesn't close with inside the body of the previous either. So a slight false signal, but one that you could still, if you wanted, have a look at the high of the candle previous to it and try and play it like that. But that's one that I do feel slightly lower percentage. It works out on a chart in hindsight. You go, oh yeah, I should definitely have been taking that all day long. Not entirely sure that you really should have been taking that all day long, just because the way it's not fulfilled all the criteria, and that I think is one of the most important things of any sort of setup, any trade, that you're like, yeah, that looks good, but it looks good because you want it to look good, because you fancy that as a trade, and actually it's not really stacked everything up in your favour, and that's where you kind of need to sort of step back a little bit and go, okay, this isn't quite the one. And perhaps you look for a different reason to be in. Perhaps you look for, again, you got another little inside day here, so that might be your opportunity for a break. So it's just then a case of switching your bias, or just switching to a different look at things. Piercing candle in the euro, right down at these lows down here. You get a small gap down and then a run straight the way back up. So what we'd had is effectively a little wedge in the euro. Wedge breaks to the downside, you get a gap, and then the gap runs straight the way back up. So with the break of this wedge, you would be expecting continuation to the downside. And the fact that you don't get it, followed by a gap and then straight up, is a pretty strong sign. And that's where you want to be long. You then get a nice opportunity as we come back into the wedge to then play it to the other side of the wedge and look for that continuation higher. So it, again, gives you a bias, and then sets you up to have a look at other things. So maybe you start looking at that wedge break and thinking, yeah, this is something I really want to be on. And then you do get a very, very strong move a couple of days later, which properly rushes the market higher and gets your push up, consolidation, and then continuation higher once again from there. Everyone happy with those type of candles? Nice. Yeah, I think they can often be some of the best ones in terms of indication as to what's going on next, where the next moves are coming from. All right, this is what Peter was asking about earlier. 50% of the previous candle. Marabuzo line. I believe Marabuzo means bald man in Japanese. It's not necessarily my trade, but there you go. It's 50% of the open to the close, not 50% of the range of the day. And that's where it can catch a few people out, or that's where it's one of these things that not everyone looks for and don't realise when the market stops in their perception in the middle of nowhere. Everyone goes, why has it done that? Marabuzo. I look at it more as a marker for either a target or a short-term scalp. It's not something that I'm necessarily going to be looking at and thinking, this is the end of the move, this is the top of the move. I know that some people will look at it like that. So if you have large down day, the next day comes in, we move up, the idea would be get short, target a new low. So you're looking at it for a pullback for a continuation type trade is the one way of doing it. I do feel that particularly if we've then traded lower and then start moving back up, that's where I'd be looking at it as a target and also as a place to take a little bit of profit short term. We'll go and have a look at a couple of examples of this in a minute. Euro stocks, in fact, the last couple of days has played off Marabuzos quite nicely, or certainly from a chart point of view, looks like it has. So yeah, in terms of the reversal patterns as well, that gives you quite a nice little target rather than going right the way for the other side of the range, right the way for the other end of a move. So get your eyes on Marabuzo line. The key thing or key sort of determinants of whether you can have a Marabuzo, you can't just put this on any candle. You need to see an extended range candle. I would also suggest that the open and close needs to be within 10% of the high and low of the day. What you don't want to see is a candle with, big wick on both ends plus a massive range. They're the type of candles that you're better off to look at the midpoint there than that Marabuzo. The Marabuzo is there for the very solid up or down days. And like I say, with range extension, so beating at least current averages or what you would perceive as a normal large day for whatever market you're trading. That's something that you should all have in mind. Generally a sense of what a normal day is, what a small day is, what a large day is. For example, I would suggest that a DAX, a small day, is about 30 to 40 ticks. In fact, that's very small. 50, I'd say small. 100, I'd say is normal. 100 to 120. Large, I'd say anything over 200. So I would not consider drawing a Marabuzo line on the DAX unless you've got at least a 200 tick range. Solid candle as well. So that's how you want to be looking at those. And like I say, I'll whip that Euro stocks chart up in a minute. Show you the calculation and also how it managed to stop at them quite nicely. Right, 3 soldiers, 3 crows, 3 Indians, I've heard them called, 3 whatever you want to call it. Generally, 3 crows go up, 3 soldiers go higher. It's 3 black crows because originally candlesticks were black and white. Seems we might have some technical issues at the minute for those of you online. So if you can hear me, Paul's trying pretty hard to try and get it all back up. So hopefully we'll have it back up in a second. But for everyone else here, yeah, it was 3 black crows because of they used to be white and black candlesticks. The idea behind this is more something to give you context than anything else, and this is something that I think really does work best on a daily type of chart to give you an idea of what to do the next day, what to expect the next day. I think in terms of your expectation of the next day, 3 soldiers or crows probably gives you the best indication of what's going to happen the next day, and also a very clear way of playing it in terms of your bias for the next day. So the way I'd be looking at it is,
There's no screen.
are we still recording?
Yeah, but the screen's blank, so I'm just going to start it up again.
Okay.
So if you want to give it like a minute.
Yeah, we can.
Yeah.
You guys all right to wait a couple of minutes?